Saurabh Mukherjea. He's been owning, investing, and he's been advocating to his clients and to our viewers that franchise like HDFC banks are rare to find. But when, like Buffett has always said, that when good businesses go through a temporary lull, that's the best time to buy, right? So Saurabh Mukherjea, I thought I'll ask you on markets. I thought I'll ask you on mid caps. But when HDFC Bank falls by 5%, that has to be the first question.
Yeah, and it tells you a lot about the world that a bank of this scale can report 20% growth in loan book, improvement in asset quality, and still fall 5%. I found the results to be solidly reassuring. I appreciate that some people are worried that the deposit growth isn't as high as expected, but my reckoning is that will come through. Sashi Jagdishan reiterated that this fiscal they'll set up 1,000 branches. I know that the previous target was 1,400. I reckon they'll get back to that number. Just to put 1,400 branches a year, opening 1,400 branches a year into perspective, a well-run regional bank like Federal Bank has all of 1,400 branches, right? So Federal Bank is a good bank. They have 1,400 branches in total. What HDFC Bank is aiming to do is set up 1,400 branches every single year. This year, they seem to be on track for 1,400. Operationally, the bank is in good shape. Deposit growth, whilst less than what market was expecting, is still on an incremental CASA basis. They're pulling in 15% of India's CASA, which I think is very impressive. So we remain happy with the position. I think something like 8, 9%, perhaps even close to 10% of our flagship product is HDFC Bank. And we'll stay invested, perhaps look to buy a bit more, given that it's trading on 20-year lows on price to book.
But the challenge with HDFC Bank is that just like you like it, everybody likes it. And when everybody likes a stock, the appetite to buy into that stock perhaps could be limited and restricted, while 20% growth is enviable. This kind of expansion is admirable. But some would say that everybody is not fully invested in HDFC Bank. Everybody, in a sense, is now swimming, and some are also drowning in HDFC Bank. It's like a stock which is consensus buy for everyone. Where will the fresh appetite come from?
So if you look at it, Nikunj, I think there's been pretty meaningful reduction in institutional exposure, both FII and DII, to HDFC Bank ever since the merger was announced with HDFC Limited. So over the last 1.5 years, institutional exposure has pulled back, which is why the price to book has come off from 4 times down to 2.2, 2.3 times. And the institutional sell-off has been driven by this point of view that the merger will be difficult to execute, that something on this scale has never been done before in Indian banking. And in parallel, the PSU banks have posted good results. So there have been other alternatives for institutional investors to load up on India. So that's that's where, if you say it's a consensus buy, I appreciate for brokers it might be, but on the buy side, there's been on the institutional investment side, there's been a fair bit of selling. My reading is that selling abates, and as the company stabilizes, as the numbers stabilize, we will see institutional appetite returning. Remember, merger synergies haven't yet kicked in. Without merger synergies kicked in, HDFC Bank is doing around 1.9% ROA. If that trickles up to 2% ROA, assume gearing of 9 times. This is an 18% ROE bank. We're looking at an 18% ROE bank, even without meaningful merger synergies kicking in. And an 18% ROE bank growing consistently at 20% at this scale. We don't have too many other lenders operating on this scale at this level of profitability anywhere in the world. So I reckon investors like us have to stay patient. Operational delivery post-merger has been solid by the management team. They're doing a good job, and we'll stay invested here. And I think other institutional investors will see the logic of coming back to HDFC Bank at what are mouth-watering valuations.
Patience will be the key, Saurabh, right? Sabr ka phal meetha hota hai. I think we should start saying that for HDFC Bank. Okay, I'm going to shift gears and talk about the health of the market. We are off to a good start. Markets are certainly not worried about budget. Nobody's talking about elections. Everyone is saying Jai Shri Ram, right?
It's vote on account, so one shouldn't buy about the vote on account. And you're right, political stress has been taken out of the way by the assembly election results. Where I think the degree of optimism that I'm seeing kicking in, leaving aside budget and the political outlook, Where the optimism actually is warranted is the interest rate outlook genuinely is positive, both in India and in the rest of the world. I know events in Middle East are a little worrisome, and if the rebels and the Houthi rebels and the Israel situation flares up, perhaps oil goes back up again. But leaving aside the Middle Eastern concerns, the interest rate outlook is positive for the country. The growth outlook is positive. Political situation is stable, and therefore on all of those fronts, the optimism in the market is warranted. Small cap valuations do look completely out of sync with reality, but large cap names such as the one we've been discussing this morning, Nikunj, the large cap end of the market, I don't think valuations should raise concerns.
Have you trimmed your position, Saurabh, on any of the mid or small caps that you own?
No, so we continue to be invested broadly in the same set of stocks. Where incrementally we're becoming more comfortable is in the sector which gave us the most pain in 2023. I think, as is well known, we have been large investors in specialty chemicals for several years now. It worked for us for 3 years. Last year, we were absolutely hammered in spec chem because the Chinese dumped chemicals all across the world and in India from May through to October. The Chinese dropped prices of chemicals by anywhere between 30 to 50%, and that hit our investee companies there. November, December, the Chinese seem to have throttled off on dumping. The import data is encouraging for India in that regard. And ironically, with these shipping rates going up, right, shipping rates, container rates seem to have doubled in the last month because of the situation, the terrorist situation in the Red Sea. That implicitly acts as a deterrent on Chinese dumping because the shipping rates go up. It gives a degree of protection to Indian spec chem manufacturers. So we're looking forward to the spec chem manufacturers publishing decent results for the quarter to December, and hopefully, giving the world a little bit of optimism for calendar 2024 in terms of respite from Chinese dumping. We remain big investors in the sector because we believe the China plus one story in chemicals is massive, and we would rather keep loading up on spec chem names at very attractive valuations rather than wait for the uncertainty to abate and then the valuations just rip through. So spec chem is a sector where incrementally we're becoming more confident about the outlook, and therefore names like alkylamines, GMM, Pfaudler, where we've had large holdings, we're staying constructive there.
Enough. What about some of the compounders in the portfolio, the likes of Trent as well, Fifth Tata Group, incidentally, to top the 1 lakh crore market cap? How do you see that as a performer along with an Astral?
So on retail, it's very interesting what's happened in Indian apparel retailing. It's become a very demanding market because of the rise of online and how online and social media has shaped tastes of the Indian consumer. If you're a run-of-the-mill apparel retailer in India, not on the cutting edge of fashion, you don't have sharp pricing, I think you're finding life very difficult. And I think we'll see that in the Q3 results. None of them in apparel retailers are finding the going really tough. All credit to the team at Trent, Noel Tata, Venkataslu. What they've created is very impressive. Not just the West Side proposition, which is a familiar proposition for middle class shoppers, but the Zudio proposition is very, very interesting. I've traveled to now, I think, 40 Zudio stores in various parts of the country. Fashionable clothes, attractive price points, constant refresh. Every 7 days, the lineup is getting refreshed. And if Trent keeps scaling Zudio from roughly 450 stores currently to say 2,000 stores over the next 3-4 years, I think this becomes a massive compounder. Zudio becomes a massive compounder for Trent. And then in parallel, Star Bazaar, we've been visiting stores consistently across the country over the last 5-6 months. We think Star Bazaar 2 is a very disruptive proposition. It's a very different type of grocery retailer to what we've seen in India. And we think the format works. We are seeing stuff fly off the shelf at Star Bazaar. We reckon that's on the cusp of profitability. So on our numbers, this is on somewhere around 50 times earnings. And we think the combination of Zara, West Side, Zudio, Star Bazaar, you've got a quadruple play there, which could make our clients a lot of money in the years to come. So both in consistent compounders and in rising giants, this has become an increasingly large position for us.
Sort of not an apple-to-apple comparison, but that also brings me to the next end of the curve. And, Nikunj and I often have a discussion about models like an Avenue Supermarts. They're really struggling, right? Because what's holding up well is the entire K-shaped recovery theme, the urbanization trend. Where does it leave models like Avenue?
So I think there's positives there and perhaps a couple of things there for management to think about. We're not shareholders in Avenue, so all the other names that I mentioned, I'm invested through Marcellus's PMS, so are my parents, and so are our 9,000 clients. In Avenue, we're not shareholders, but it's an impressive business model. As you're alluding to, Aisha, the groceries piece I think is fine there. The FMCG piece is fine. Where they've had a bit of a challenge over the last couple of years is the what they call the hard lines, so merchandise, clothes, curtains, pots and pans. Um, and the reason for that, as I say, the reason I think it's becoming harder for an Avenue to sell clothes is the budget buyer, the buyer who purchases clothes of 400, 500, 600 rupees, that budget buyer of apparel has become very discerning. And therefore, you can sell clothes to the budget buyer, but your positioning has to be pretty sharp on the fashion front. If Avenue can upgrade its buying and refresh the lineup of clothes and Avenue stores in DMarts, if the lineup of clothes that we see in DMarts is refreshed and made sharper, I'm sure they'll see improvement in their operating margin, because the operating margin gets dragged down. The margins get dragged down if you sell fewer clothes and fewer hardline merchandise at the DMart stores. That's where the struggle has been. Radhakrishan Damani ji is a legend. Neville is a super CEO. So they've got smart people. I'm sure they will try to figure out how to get their apparel sales revved up. And Zudio is a perfect case study right in front of them.
Saurabh, let's look at two stocks then. We've discussed HDFC Bank, the other one is TCS. You've owned it and you've liked it. Now there seems to be a early recovery which you can look at IT. At least the managements are sounding confident that worst is behind us. So is HDFC Bank, which is a contra and a value buy, is that a better bet, or is TCS a better bet given that the industry now after 18-24 months of a gut-wrenching contraction is now turning?
So I think if you look at the two stocks, Nikunj, TCS and HDFC Bank, TCS's business has operating levers, but then this is not an industrial play. So TCS is an IT services firm. Operating margins are super healthy anyway, around the 25% mark. And yes, as the big order book, I think it's a $10 billion order book, as that comes through, the EPS growth, which has sort of gone down to low double digits, perhaps even single digits in some quarters, the EPS growth reverts to the long-term normal of 15, 16, 17%. And TCS therefore should have a good run as the Western economies recover over the last couple of years. What TCS hasn't had is a massive derating in valuations. HDFC Bank has had that. So with HDFC Bank compared to TCS, you're potentially looking at 20% earnings compounding and a re-rating, whether you use price to book or PE, doesn't matter. So you get a double play on HDFC Bank, 20% underlying compounding in the business as opposed to say TCS is 16, 17%, and a powerful re-rating. And therefore in our portfolios, the HDFC Bank position is much, much bigger than the TCS position.
Okay. How do you see 2024 being different from 2023? Largely because of macros and moving parts like inflation and interest rates.
So I think the first big difference is we are optimistic that the private sector capex story revs into high gear. Private sector capex really hasn't done much in India since FY19. All the heavy lifting has been done by government capex, which is roughly tripled by our estimates since FY19. Now, private sector capex plays are very different from public sector capex plays, and therefore, say in our portfolio, we have names such as RHI Magnesita, which is a play on the steel demand in India continuing to run up, and all the steel plants in India needing more capacity to be installed. Similarly, Grindwell Norton is a play on private sector capex. It's an abrasives provider. So the public sector capex providers would be, say, the public sector capex beneficiaries would be cement, EPC companies. They have had a tremendous run over the last couple of years. Our reckoning is private sector capex ka time aa gaya hai. The second areas, as we were discussing, IT services. We also own engineering R&D companies like Tata Elxsi and Tata Elxsi and LTTS. The ER&D companies and IT services companies have had a rough couple of years. As the Western economies recover over the next couple of years, we should see better numbers come through from LTTS, Tata Elxsi, Infosys, TCS, and so on and so forth. And the third area would be private consumption. Private consumption actually has been pretty weak in India. The latest GDP print, private consumption was growing at, I think, 3 or 4%, which is unbelievable in the Indian context. I reckon private consumption in India will pick up as the private sector jobs market and the interest rate cycle moves in the right direction. So consumption related pays, we just discussed Avenue. Consumption related pays in India have had a tough time over the last couple of years. Aisha alluded to the K-shaped recovery. I think several of those issues could be less painful in 2024 than they were in 2023.
Saurabh, thanks so much for joining in, discussing, of course, HDFC Bank and then stocks across your portfolio. Good to have you on board.